Welcome to TheoTrade. This is Don Kaufman. It's June 16th, 2023. Just about 48 minutes left inside of this trading week. And what a trading week it has been. The extremes of the markets stress test the shorts. And I'm going to tell you right now, I am one of those shorts in this marketplace. And people, it has been absolutely extreme throughout the course of this week. So, on this weekend's update, I'm actually going to take you specifically into my own position. So you can actually get a feel for how am I kind of managing it through what has been just an explosive rip to the upside. The other aspect of what we're going to be covering here, of course, in detail on this weekend's update is it's a gamma squeeze, it's a short squeeze, but look, the drive higher, it's not what it appears. And I want to make that abundantly clear. There's nothing but, chatter. This is why we're going up. And I'm actually going to get to the specifics, okay, behind how this actually occurs in the marketplace. And when I say occurs, what occurs? I don't know. Take a look over at the spiders. And let's move away for intraday trade for a second. How do parabolic moves like this occur, okay, in a major index? Meaning when I say parabolic, I'm talking about that. I mean, this thing looks like a launch trajectory, if you will, inside of the spiders. And of course, this is the spiders. We haven't even begun to discuss the Nasdaq, which is just, I mean, it's wild. It really is wild. When we start to apply things like auto expected moves, just so you get a feel. I mean, when the marketplace, you know, is for instance wrong, like where you're expecting, and I'll give you a quick example here inside of something like SPX. Here's the S&Ps, and the S&Ps are expecting this week like a $65 move, and you get like $125 moves. You got to realize, I mean, that is just, it's wild. Okay. And this is precisely the type of move that on Wednesday night we were talking about higher probability, lower probability. But the move that we warned was the lower probability, and that was going to be an explosive, unrelenting move to the upside. Unfortunately, that's exactly what we got. Now, again, there's still a lot of time left in the trading day, and the S&Ps are selling off. But look, that's neither here nor there. Like what has occurred has occurred. Like, look, we've exploded to the upside, okay? And we're going to get into context of the how and why, okay? And what we can kind of expect maybe moving forward. And I'm going to kind of lump a little bit of this together over here. So the first thing that I want to talk about, because we are going to get into some stress test over here, which doesn't sound exciting, but how you manage your positions, okay, in the midst of the extreme defines you in this business. Plain and simple, it completely defines you. And I actually enjoy like showing positions, good, bad, or indifferent. I'm actually going to take you into detail, not just of like one position. I don't care. Look, we're actually going to take a look at the full Monty, like every position I've got on over here, how many deltas I'm long or short. And I'm actually going to SPY beta weight this for you. All of it here is going to be covered in this weekend's update. Let's get right to it. Before we get into, portfolio beta weighting and okay, let's just talk about the markets in general. So this week there's a rip to the upside. And for this, I'm going to bring up the S&Ps for just a second. Now this is not a continuous contract. There was a contract roll, but again, you can see what I've kind of termed a parabolic move, just a huge rip to the upside in the marketplace. The first thing I want to discuss is there's all this conjecture. How did this occur? I'm late to the game. There's fear of missing out. I got to get in. How about this? Okay. The bottom line of what you're seeing throughout the course, okay, of really the break outside of what was an incredibly long streak in a volatility box. And again, let's be very specific, because for those of you that are a little bit newer, all right, what are you new? Okay, from basically right in the beginning of April, okay, all the way to literally right in the end of May. So you had April, okay, and May, all is inside the exact same range. We knew unequivocally that breaking outside of this range, I mean, I talked about it for 8 weeks, about how the open interest was going to accumulate and it was just going to have a crescendo. And we had no idea which way we were going to break. But when we broke, we knew it was going to be explosive. And explosive it has been. Now, one thing, and again, I have called for is that there might have to be an up, if you will, before a much more, down move. And I, at this point, continue to sustain, okay, negative delta, which means I'm sustaining bearish positions. And that's why I'm saying, like, hey, look, extremes of the markets are going to stress test, okay, every short, including me. All right. It's intestinal fortitude at this point. But what you need to understand about the present move higher, okay, is what's actually driving it. When I start to talk about things like a gamma squeeze, it just blows people's minds. But look, I'm going to try to make this very, very simple. Yesterday, okay, yesterday specifically, which is Thursday, okay, of this week, and June 15th, there was actually a record number of call options that were being purchased inside of products, specifically the SPX. Okay, so for this, I'm actually going to cruise over to the SPX for just a second. Now I know I've got all these lines in the SPX. Let's turn them off for a moment, right? Just go to the default chart. This is the SPX, the mother of all products. Okay, what has transpired in the SPX? There has been a tremendous amount of what? Okay, buying calls, right? So we're out there and we're buying calls. Traders are buying calls. Now, as they buy calls, okay, what has to happen on the market making side of this business? So over here is the market makers. And the market makers, what are they effectively doing? Okay, they are selling those calls. All right. So they're actually selling the calls. Now, what blows people's minds, and when you start looking at this from a more, if you will, delta perspective, you might be out there buying calls. Proprietary trading firms, just trading firms, are out there buying calls. The market making firms don't care. They'll sell you all the calls you want. Okay. And as the market starts to go up, obviously they're adjusting the price of those calls. Okay. But lo and behold, these market makers over here are hedging. How are they hedging? Okay. By turning around and doing what? Well, this is the confusing part. When you're buying calls, you're producing positive delta. For the market makers, you're producing negative delta. That negative delta is offset, okay, by positive delta. How do they actually get positive delta? They buy, okay, ES futures, because there is no underlying in the SPX. They just buy S&P futures. Now, think about that for just a second. If you turn around and you buy ES, where's the marketplace go? It goes up. This is actually the makings of a gamma squeeze. And the gamma squeeze, okay, for all intents and purposes, that gamma squeeze has been very much isolated to individual products. It's stocks like Nvidia and stocks like Microsoft. Okay, it's been your Tesla, and you've seen these parabolic moves all of a sudden, okay, towards the latter portion of this week. Now all of a sudden you're seeing the gamma squeeze appear inside of the SPX, and it got dangerous. Right. And that's when you start seeing things like, wild 2 sigma type moves out there. Now, in combination with the gamma squeeze, okay, it was said that coming out of this kind of volatility box, I say coming out of the volatility box, we're coming out, right? This is the 4211. All of a sudden we explode off of it. And then we just start ripping higher. Okay. It was said right around that 4211, there was actually a record number of shorts. So now you're actually compounding risk, again, of this perpetual gamma squeeze, because the more we go up, the more the making firms have to hedge. But the higher we go, ultimately, what has to happen? Well, the shorts get squeezed and we just continue to pop to the upside, because how do you get out of a nasty short position? You buy back, okay, whatever it is, you cover and you buy, and then we again continue to go higher. It does appear that we have a combination right now of just that. See, the thing that I really wanted to drive home over here, okay, is that markets moving higher, okay, are not necessarily like a function, because people constantly ask me this question. It's not necessarily a function of like, who's buying Tesla at these levels? How about Tesla just goes higher, okay, because of these dynamics. Because of the dynamics, if you will, of a gamma squeeze, because of the dynamics of a short squeeze. It's not necessarily someone like, I'm going to accumulate stock. It's the market making firms that are actually buying shares. It's, you at home that are buying calls. Okay, that's actually driving what I call like, the feedback loop, or what I'm really terming like perpetual motion, if you will, to the upside. We start to literally spiral out, out of control to the upside. Now, the upside move, okay, for all intents and purposes, just as vicious lately as any crash would be in the marketplace. The only saving grace, okay, is that the upside move does not bring the heat of volatility with it. And that's one of the most critical things to understand, okay? No matter how painful this upside move might be, okay, and I'll use the spiders in this case, no matter how painful it might be, you actually have, okay, a VIX that's actually collapsed inside of it, which if you've sold premium and the volatility is coming off, at least that's not an issue. It's like a crash to the upside, except it's not, because the volatility has actually subsided. And again, as I said, that's a little bit of saving grace. So it's a gamma squeeze plus a short squeeze that is really the mechanism, okay? If you're looking at, like, specifically what's causing what feels like it's just an unrelenting move to the upside, yeah, people are getting squeezed when you have a record number of shorts, okay? And then you have people going out there recognizing that and buying calls. It's actually forcing markets higher, okay? That's the machine that is behind, okay, what has been one of the more vicious moves we've ever seen to the upside. So as I said, moves higher, okay, it's not what it appears. I don't want anybody to think like, hey man, I got to get out there and buy me some Meta. Hey, I got to get out there and buy me some Tesla. Look, nobody in the market making side, none of the proprietary trading firm, nobody cares like that these stocks are even going up. They're just involved in arbitrage. They're just involved ultimately everything from volatility arbitrage, statistical arbitrage, okay, market making action. They just don't care. And yes, they don't care, but it does move the stock to the upside. It is what it is. As long as they're making money, everybody's happy. And I got to tell you, yesterday, the marketplace did 55 million option contracts. And that was the day before option expiration. Today is actually triple witching. With that being said, okay, the reason I was pointing this out, the gamma squeeze plus the short squeeze and the moves higher, not what they appear, because nothing screams that more than when you saw the Fed, the ECB, more rate hikes ahead. I mean, the Fed literally said, don't worry, we probably got 2 more packed into the end of the year, between now and the end of the year, 2 more rate hikes. Does the market care? No, it doesn't. It doesn't care at this point. The ECB doesn't care. CPI came out. Cool, didn't care. PPI, jobless claims rose substantially. It does not matter, okay? Even the news right now, you got to look at news as like a fuse being lit in the marketplace, okay? That's just going to perpetuate whatever move is already, okay, underway. And one of the reasons that I put into these notes over here, the Fed, the ECB, and CPI, and PPI, and jobless claims, is not to talk specifically about those events. Those events, they happen. No one cares. It just simply does not matter right now. All that matters is the moves higher are not what they appear. It's a gamma squeeze. It's a short squeeze. Okay. When this actually comes to an end, that's always going to be the question. Okay. It's always going to be the question. When's it going to come to an end? Let's say sooner rather than later. But, squeeze situations like this, they'll fade, and they fade, right, when most of the shorts are actually squeezed out. Okay. And there is no question that on, of course, Thursday of this week, it got ugly. There's just, coming into the cash close here, this is where people got squeezed out. Well, we've given back a little bit of that today, but come on, it's not even nominal. It's a nothing move. Like looking at the S&Ps that are basically down 10, it's massively unchanged. The reality is, okay, for this marketplace to come to an end, it's not going to be, going off quietly into the night. When the squeeze is over, my best guess is that we're actually going to have a gamma squeeze back down, which could be a very violent move. One thing I implore you to listen to: do not, okay, as we're rallying, sell puts to try to mitigate some of your directional risk. What that means and listen, I'm geeking out for a second, but what I'm saying is, as we're actually ripping to the upside, don't run out and sell puts as we actually go up, okay? So as we're going up, people are selling puts, trying to balance out their delta. And you'll do that, and all of a sudden, boom, we're going to come down very, very quickly right on top of you. That is not a risk mitigation technique, okay? That's only going to bury you a lot deeper in here. So the S&Ps right now, again, when it's done, what you will feel, okay, is going to probably be the exact opposite. I'm not saying there's going to be, this incredible sell side activity, but the entire logic of a gamma squeeze works just as effectively to the downside as it does to the upside. But what's contributing to this right now is, again, there was a record number of shorts. Nevertheless, as we start to go down, those shorts will pile right back in, right? You can pretty much count on it. When they do pile back in, you have to realize, okay, you have a marketplace that doesn't have nearly as many shorts because we exploded higher. When they pile back in, what do they do to pile back in? They sell into selling. Okay, now let's actually just cut to the chase and start to talk a little bit about positions. This is not going to be a session we're going to look at Teslas. And, okay, it doesn't matter. It doesn't matter at this point. Look, the market's ripped. All right, we have a mixed bag of goods, but everything for the most part is to the upper edge of the expected move, including one of the things that surprised me this week, the financials continue to actually, really rip to the upside. With that, as I said, we're going to cruise over and we're going to look at my position because I wanted to give you a little bit of position update here on this weekend's update and how to handle this. So one of the first things here, so yeah, I do use thinkorswim to look at a position update. I also use Tasty extensively, right? And Tasty, you can come over here to cap requirements and actually take a quick glance at different positions, all right, and actually pull up risk analysis. Right? And this risk analysis is just as effective as what we do on thinkorswim, okay? But my own comfort, okay? And again, over what? 20 years plus on thinkorswim and helping actually build some of this tech in the Analyze tab, okay? I like to talk about this. So forget about, when we start looking over here, forget about this risk profile. It's useless. Because I'm actually spread into at least 3 expirations. What I've done in here, my S&P position, this is S&P options and futures. Doesn't matter what the position is, okay? All that matters is, are you comfortable? You have to be able to answer that question. We say, are you comfortable, all right? This is nothing more, okay, than options and futures. And I've sold out of the money options, okay? And present risk right now, it's not that great. It's not that huge. But what I want you to see, okay, and what to take away from this, look, what this says on the screen, and again, for those of you that are watching this at the at-home game, I know it's kind of hard to see if you're on a mobile device here, but I'm looking at the market and I'm saying, what if I move up 3% or down 3%? What if I move up 6% or down 6%? What if I move up 9% or down 9%? One of the things that, again, I implore you to understand is that here in the analytics, I don't care what you think. You shouldn't care what I think about market direction. There is no room for market bias right here in your risk management. This is a risk array. And on a risk array, all we do is simply say like, hey, look, okay, current risk, my current risk. So today, in whatever position this is, the ES position, I'm down $282 today. If the market rallies another 3%, dun, da, 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 I'm going to be down another $5,000. Am I comfortable with losing another $5,000 if we rally up 3%? If the answer is yes, good, go fish. You got to think about it that way. If the market rallied, let's continue with this. If the market rallied another 6%, hurt me. If the market rallied another 6%, I'm going to lose about $13,000. Okay. At some point in here, you're going to say, well, I'm not comfortable. How do you mitigate this? You could either close positions. You could actually use a type of a hedge. I mean, that's what we do here at TheoTrade, right? Close a leg of a position. Anybody can do that. But look, right? One of the things that you'll figure out real quick is pretty strategic about how I actually laid my positions out. I don't have to make like this alarming decision over here because I'm distributed very, very well into multiple expirations. So I'll just give you an example. If I didn't like my risk here, if I did not like my risk, I could literally close. And I'm showing you unchecking one trade, uncheck one trade. Now we can go up 6% and I don't lose $6,000. Okay, done. That's how easy it is to learn how to mitigate your risk. Now, if you want to see a little bit more of a complicated risk picture, I'm going to kind of show you a little bit of the full Monty here. And the full Monty happens to be, let's actually get into my aggregated position. So on thinkorswim, I'm going to come in here, okay? And I'm going to type in SPY. So I'll come into spiders and I'm going to cruise over here and say portfolio beta weighted. There are no simulated trades in here. I'm hiding all simulations. Everything you see right now is a live position. What I want you to gather, okay, is this is my risk array. Right now on the zero line, okay, I'm up about $2,400 today. If the marketplace is going to rally, it's going to hurt. Okay, if the marketplace is going to rally, a 3% up move, I'm going to lose about $40,000. 3% down move, okay, I'm going to make just over $40,000. So what I've actually done is I've already kind of balanced out my risk to some degree. I don't have like, negative risk reward in here. I'm also collecting about $200 a day in decay. I'm collecting a lot more decay if I actually added in some of the tasty positions as well. But I can even come in here and add in, if you will, an IRA. I'm sitting right now in terms of SPY beta weighted deltas with negative 3,441, okay, deltas. That basically means I'm big boy risk, all right, inside of the marketplace. And that's one of the most critical things. Okay, why am I showing this to you? Why here on a Friday afternoon into a holiday weekend? Because what people are not doing right now in this marketplace, and again, it's why I stress you really need to understand this, okay? What people are not doing, they're not looking to the forward future. They're not looking and saying, well, they're like, it's got to go down eventually. It's going to sell off, isn't it? Okay, you don't know that. Well, we could be up another 15%. I have no idea how long a gamma squeeze can last, and neither do you. And from a risk management perspective, if I'm going to sit, okay, with somewhere over 3,000 SPY deltas, okay, in the extreme of a rally like this, you better believe that I'm going to know pound for pound, penny for penny, what I can make or lose at any moment in time. And I'm not in here to show you, oh, is it 3,000 deltas? He's crazy. Maybe. I don't care. That risk is comfortable for me. What risk is comfortable for you? You need to play that game yourself. You need to look in here with absolutely no bias. And I keep stressing that because the moment you have a thought about which way the market's going to go, you're done. You're no longer a risk manager. At that point, you're just a passenger in a really, really crappy plane ride. Right? So think about that for just a second. If you understand deltas, phenomenal. So what? I'm negative 3,112 deltas. I understand P&L in the day, and that's my P&L today. And after you actually are comfortable with that, take the date, shove it forward like 2 weeks, okay? And you'll see the positive theta actually pours into the account. So it actually helps, if you will, some of that risk reward. Look, this stuff is critical, and there are many a video here at TheoTrade specifically on this. For those of you, of course, that are members of TheoTrade, okay, tune in to a couple of those videos. Anything risk management related, I'm going to do a huge amount about that, of course, in the coming weeks as the marketplace, again, it's stress test, it's in the extremes right now, and it's okay, so long as you can actually see the forward future of your risk, whatever that position might be. All right, last thing as I cover each and every week here on TheoTrade, SPX and the SPX expected move. As I said, the SPX absolutely shattered the upside, okay, of the expected move. The expected move was 65 bucks, okay? Actual move, well, it ain't over yet. So it's plus or minus like $65. And again, it has just ripped through it. Question is, what are we looking at for next week? I want to reiterate that next week, it is a holiday week. We'll be closed on Monday. So taking a look out in time, 7 days out, okay, we're down to about a $53 expected move. Now, I find that interesting because, again, we even have one less trading day, but the expected move still decent. Okay, even though vol has come off, those expected moves, they're still decent. As I said, markets right now, look, don't just look at this and say, oh, the Nasdaq is down 50, it's all over. It's not over. Again, markets are really good at pushing shorts, okay, pushing buttons over there. The expected move, it's lower, but on a 4-day trading week, people, you need to anticipate this could go on for much longer, and that's exactly why I wanted to go into detail here about that stress test. Are you comfortable? You need to be able to answer that. Thanks everybody for joining us here at TheoTrade. Have a wonderful holiday weekend. Bye-bye.